the government faced one of the biggest financial crises in history.
It was incredible. You can hear wave after wave of selling hitting the market.
It was a day when the Bank of England lost billions.
September 2008 brought the largest bankruptcies in world history, pushed over 30 million people into unemployment, and brought many countries to the edge of insolvency.
Hello, welcome to HKU Financial News. I'm Ginny. The main topic today is the similarities and differences between the Asia financial crisis in 1997 and the financial crisis in 2008. We're delighted to have Kenny, the Chief Economist of Hong Kong Financial Views, and Charlie, the Chairman of HKU Economic Department Association, to join our discussion.
Hello, Kenny and Charlie. Welcome to our discussion. Could you say something about the topic today?
Yeah, sure. So today we will talk about the background of both crises, and then we will draw a comparison between the similarities and also differences.
We hope that the information can help our audience to understand more about the global economy and also to forecast the future economic landscape. So to begin with, you can see in the graph the interest rate of Thailand has been increasing from 1993 to 1997 before the crisis. It was partly because of a large current account deficit that so much debt was accumulated in Thailand, and people were afraid that the debts would go default. Therefore, high interest rates was charged. It also means that investment are more difficult because the cost of borrowing is higher.
A high interest rate makes the Thai baht less competitive, with further reduced export and increased import. On the other hand, high interest rate made the investment return in Thailand more attractive. So money flooded and created economic bubble. Therefore, speculators began to attack the Thai baht, who further lowered exchange rate to generate larger profit. Hence, Thai government used foreign reserves to purchase baht to stabilize the declining baht, but failed at the end on the ground of near total depletion of usable foreign exchange reserve in June 1997. They floated their currency and the baht depreciated significantly, instantly lost 15% of its values.
That was what happened in Thailand in 1997. And how did the problem spread to other Asian countries quickly?
So the floating baht led to a very rapid depreciation, and also there are also a broad loss of confidence over the Asian market in other economies, because they thought that similar problems would happen in other nations. And also, on the other hand, other Asian currencies depreciated at the same time. While Asian currency kept depreciating, many firms went default at the same time. This is how the economy collapsed in Thailand and also spread to other economic nations in Asia.
From what you have both mentioned, it seems like Asian financial crisis in 1997 really cost the global economy a lot. It must have taken a long time to recover. So how about the crisis in 2008? Why was the other financial crisis in 2008 triggered again?
So after the financial crisis in 1997, the Asian countries fought very hard to boost the economies, and also resulted in a larger national income in the emerging market and also the developing markets. And they saved a lot of reserves to prevent similar problems happening again. There was an excess gross saving over investment in the emerging economies, especially in China, under the global saving glut, which resulted in a global imbalance that the US was in a huge deficit and Southern Asian countries were in surplus. So you can see that after the financial crisis in 1997, China and other Asian countries were experiencing a larger proportion of GDP as saving. They became more prepared for the future economic distress with more savings. Meanwhile, you can see that the United States and also the other European countries were having a low level of GDP as savings, which is approximately 2 times lower. The surplus countries' current account surplus was flowing into the United States financial market, which also pushed down the US long-term interest rate and also global interest rate.
It fueled the increase in liquidity and also credit. And also with a federal fund rate at 1% from 2003 to 2005, there was abundance of cheap credit and also a high incentive to leverage. Lower rates means that the investors couldn't earn a decent yield from the treasury bills, and therefore they turned to higher return or riskier projects, for example, the mortgage-backed securities.
Yeah, it was really easy to borrow money at that time. Some of my friends borrowed money without any collateral and they bought their houses.
Exactly. Learning standards were relaxed reporting to the is exactly every subscribed borrower with poor credit history or very low repaying ability can borrow, but it can also push up the financial market, especially in the property market. This risky mortgage will pass on from mortgage lender to the big investment banks like Morgan Stanley, so on and so forth, and will turn into low-risk securities by putting large number of them in pools and tranches according to different risk levels, which was also known as collateralized debt obligations, CDOs.
Yes, I heard that the failure of credit rating agencies by underestimating the risk of those assets, and I'm sure it is one of the reasons causing the crisis.
Yeah, so let me explain something on the credit rating and also the CDOs. For example, as you can see, currently in the United States, there are three major credit rating agencies, and they are so-called Moody's, Standard & Poor's, and also Fitch.
The main role was to provide ratings on the bonds according to the future repayment confidence. In general, the bonds were divided into two sides. One is the investment grades, and also another one is the junk grades. An investor will receive different rates as credit premium to compensate the future potential loss. And also on the other side, for the CDO, it is a structured financial product that pulls together different cash-generating assets and then repackages them into this asset pool into different discrete tranches of different risk profile, and they are sold to investors. The problem for CDO sales is that the SPVs, the special purpose vehicles, claim that the CDO is a kind of asset with good return, so people will underestimate the potential risk of investing in this kind of product. So you can see the market of CDO in the world grew very significantly during 2000 and also until 2006. The market size expanded for 6 times because the borrowing was easier, and then the SPV will have more mortgages or loans and make them into the pool and create the CDOs. So the more people purchasing a CDO, when the market underperformed, the greater loss will be suffered by the investors.
So after the crisis, the banking system was totally destroyed. Some banks like the Lehman Brothers, the Bear Stearns went bankrupt. Another direct effect would be the productivity. According to the IMF, the annual growth rate of global GDP was about 6% in 2007, and then it began to lower to about 3% to 2008, and then it became a negative figure in 2009. So it revealed that a global economic problem and that the market never recovered to the previous level before the crisis.
So, after knowing more about both crises, could you name some of the similarities and differences between the two incidents?
Sure, there are several causes of the incidents are similar. Firstly, both of them are caused by low interest rate and excess credit expansion. For both crises, there were bond credit available for firms or investors. People could borrow money for consumption or investment even with a poor borrowing record. However, when the asset return became unsustainable, people could not earn enough income to pay off their debt, which could be a problem. Their debt and so they default. This is a problem. Banks would be holding lots of valueless borrowing contracts, causing collapse of the whole financial system and even the whole economy. Secondly, ineffective risk management and government regulation also caused the incidents. For Asian financial crisis in 1997, domestic banks could borrow money from government at a very low cost to fuel high level of risk investment. Comparatively, for financial crisis in 2008, there were not any regulations to monitor leverage ratio of bank or institution. In both cases, there were not any regulatory bodies to monitor investment banks in risky projects. Firm or bank could result in great financial distress when the investment underperform in these risky projects.
The two crises look similar in terms of causes. Is this the big picture? Are there any differences on the causes?
Yeah, they're caused by different problems. So first of all, the nature are different. For the Asian financial crisis in 1997, it was essentially a currency crisis, while that in 2008 was triggered by the burst of housing bubbles in the United States. The direct cause of the financial crisis was a rapid depreciation of the Asian currency. This inevitably attracted speculative attacks on the local currency in the Asian market when the domestic macroeconomic policy fails.
While for the crisis in 2008, low interest rates allowed the mortgages aggressively expanded within a very short period, and home prices rises drastically. So you can see the Case-Shiller index, which measures the house prices, which is peak at the 2007, but started to decline in 2008 with a 19% drop. The sharp decline made investors suffer. Crucial losses of the financial institution in real estate investment also resulted. And secondly, they are caused by different moral hazard problems. So in 1997, the crony capitalism was particularly a serious problem for many Asian countries. They assume that they will be bailed out by the government so that they are motivated to choose more risky projects to capture high return. That also increased the overall market risk.
In 2008, the failure of credit rating agency proliferated the crisis by catering the investment banks to create assets favorably under market fear competition. For example, the Moody's redesigned their rating guidelines to favor the mortgage-backed securities. The market information underestimated the overall risk.
So, according to what you have just mentioned, it seems like the crisis can be detected based on these features before it really comes. Could you also talk about the consequences so our audience could understand how will they affect the economy?
So, first of all, drop in asset price and also increased market volatility were also observed. For both prices, you can look at the VIX, the VIX index, that measures the market volatility. So you can see the index reached a very large level during the crisis in both 1997 and also 2008. And the market fluctuated a lot. People went into and out of the market very quickly. That caused great market volatility, and also in terms of the asset price. And secondly, for the bright side, the crisis enhanced the cooperation among nations in both crises. So after the crisis, several cooperative bodies, for example, the Association of Southern Eastern Nations or the Asian Cooperation Dialogue, were set up to strengthen the economic relationship between the Asian countries.
Meanwhile, for the financial crisis in 2008, the IMF worked along with other organizations, in particular the G20 and also the Financial Stability Board, to improve the resilience and also the surveillance of the global economy. For example, the spillover reports were prepared by the IMF to measure the impact of stability since 2011.
Yes, so you can see that our living standard is affected in different ways, like financial market, daily life, or even the society. But still, there are some key differences on consequences. Firstly, the policy and the responses are different. For crisis in 1997, monetary and fiscal policy of Asian countries were initially tightened to stabilize the Asian currencies. Then expansionary fiscal policies were adopted to support the economy. In the 2008 financial crisis, however, the Fed reacted to the crisis in an opposite manner with unconventional expansionary monetary policies, namely quantitative easing (QE), by printing money to inject plentiful liquidity while lowering the long-term interest rate. Secondly, the level of impacts of global economy are different. In 1997, the financial crisis led to a miserable downturn in Asian countries. It also developed the global saving glut when Asian countries shifted to run a current account surplus. On the other hand, in 2008, since the toxic American embassies were globally proliferated, many foreign firms directly bore loss. More importantly, the shock to an international community following crisis was extremely acute, with a few nations experiencing protracted recession.
Thank you so much for the analysis from my two guests, Kenny and Charlie, today. We hope to see you again next week. Stay tuned. Bye-bye.
Bye-bye.